Hi, everyone, and thank you for joining us this afternoon. On behalf of myself and my partners, Don Ledoux and Aaron Peabody, we're excited to welcome you to our quarterly town hall. We really value this opportunity to connect, share insights, and help you navigate everything that's going on in the world, our country, and the markets. And there's certainly no shortage of headlines right now. And we're here, as always, to be a steady resource for you through it all. To help bring additional perspective today, we're joined by a team we hold in high regard, GQG Partners. Representing them is Josh Snyder, who will be sharing his insights on current market conditions and trends. Josh is a CFA and serves as a global investment strategist with GQG Partners. He brings over a decade of investment experience across various banking, insurance, research, and investment advisory roles. He also served as a research associate at Summit Strategies Group, where he was responsible for idea generation, asset manager due diligence, and asset class research in the non-US equity space. Josh, we're really excited and appreciate you joining us today and sharing your perspective with our clients. After Josh's remarks, we'll open it up for Q&A, so feel free to drop your questions into your Zoom bar at any time. Josh, I'll hand it over to you.
Great. Thanks, Vanessa. Thanks for that introduction, and certainly thanks everybody for spending some time, allowing us to spend some time here today. So let me go ahead and pull up the presentation into the old presentation mode here. Okay. And I just want to kick off. I mean, I want to be respectful of everybody's time, but I know naturally there's a lot of ground to cover. There's no lack of things that we can talk about. But I think it's important to just sort of shape how we're thinking about the world, particularly in light of the kind of nonstop headlines and all the different things, that we're seeing on a day-to-day basis. Maybe the last, 8 hours notwithstanding, because the 8 hours are not in this presentation. So first of all, let's just kind of kick off with a lot of the things that we've been seeing, and certainly, within the month of April across things that may be reciprocal or things that may be political. But naturally, the headlines are driving a lot of what we're seeing on a day-to-day volatility basis. But I think, from our perspective, there's a lot of the uncertainty that has been created here is what's really impactful. And so here we just have a couple of headlines, many of the things that you folks, of course, already know. But on the left side, in terms of not only how we're thinking about tariffs, I don't think the actual overall endpoint matters, because naturally these things are in flux. But we know that these numbers are high and they will ultimately be impactful. But it's also not a one-way street, right? Hence the whole reciprocal nature in terms of what's happening with the US, what's happening with China, but then also what's happening with every other country, whether it's Canada or Mexico. And then, of course, we have to layer in the headlines on the right, which, again, the last couple of hours notwithstanding, because it seemed like Trump maybe softened his stance on Powell, at least on a Tuesday. But we have to layer in what's happening on the central bank side of things as well. And there's just a lot of part of it noise, but just a whole bunch of different headlines and things that are flying that are creating a lot of uncertainty, and certainly things that we haven't seen in quite some time. But for us, I think that the really important piece here as we get into the next couple of slides is that with the tariff talk, with what's happening across central banks, and we could extend that to rates in the US, we can, of course, extend that to stocks, is the fact that we're seeing a lot of things that are changing, and we haven't seen a lot of these things for quite some time. So, for example, if we look at, and here's just focus on the U.S., and despite the, the fact that we are global investors, so we'll come at this from both a U.S. and non-U.S. perspective and also emerging markets perspective. But I found this chart to be quite powerful. Is the fact that, year to date, you're seeing massive outperformance across USA value relative to USA growth. And again, this is something that we have not seen for quite some time. And of course, we're not talking about just a couple hundred basis points. At least as of this was through early April, but it's again, the exact endpoints don't matter. Is we're seeing thousands of basis points of outperformance, of value relative to growth. And so again, this is something that we have not seen in quite some time. Along with that, as we layer that in, we're also seeing a very large outperformance of something like Europe relative to the USA. And again, of course, these things will change on a day-to-day basis, but not really the point. We're just trying to understand and focus on things directionally, that again, we're seeing this type of behavior that we have not seen in many, many years. I mean, and if we're talking kind of US versus the rest of the world, right? Maybe even 15 years or so since the global financial crisis. So we're seeing things like value outperform growth. We're seeing things like Europe outperform the US. And to us, as we just gather all the data points and really, again, try not to be dogmatic about what's happening, this does suggest to us that there's a lot of change that's underway. And so it really behooves us, again, to pay attention and understand what's happening. Now, also contrast that, at least in terms of change, as we think about what's happening in the US, certainly with rates, again, relatively atypical, certainly over the last, 40 or 50 years, that we're seeing on the days where, stocks and bonds in the US being actually correlated with rates going higher, rather than being that sort of, bastion of safety as stocks are falling off. As we talk about China, which of course will be a very important part of this overall conversation, bond yields are basically collapsing. And as we think about China overall, we've had very little exposure to China over the last, call it 3, probably 4 years. And this is just another reason in terms of why that's the case, is that expectations for growth, expectations, for the ability to, I guess, meaningfully delever or whatever the case is, folks looking for some sort of, safety across sort of Chinese assets. You're really seeing that a lot in the bond market. And to us, that is not a great signal that a lot of folks expect that what's happening, not only across tariffs, but really what's been underway across China, I'd say really since, mid to late 2020, has a very low probability of turning around anytime soon, despite the fact that really over the last, let's call it 6 to 9 months, parts of the Chinese equity market have actually done, quite well. And so as we look at this chart, and really this just goes back to the beginning of September of 2024, and again, runs it through early April, you can see, of course, there have been two pretty meaningful rallies across Chinese equities, one in, late September, early October of 2024, and then one more recently, throughout, parts of the bulk of the early part of 2025. But I think it's important, at least for us, is the fact that we're back in the big rally in September, early October. You saw the two primary indexes, so the MSCI China broadly, which almost the bulk of the index is in Hong Kong, and then MSCI China A, which reflects all the onshore Chinese equities. You're not seeing the onshore response this time around in the more recent rally that you saw back in late September and early October. And to us, that's just another data point that suggests that what's underpinning this rally really isn't very sustainable, because you don't have a lot of the onshore Chinese folks getting very excited from a stock market perspective about what's happening, overall. So our view is that a lot of this has been unsustainable for quite some time. But I think even within, the different flavors, so to speak, of Chinese stocks, you're also not seeing them really run and react in unison to a lot of the pieces of data that are coming out, overall. Now, with all of that, I think as the more kind of recent backdrop, just stepping back just a second, is to really sort of frame, and this goes through the end of the year. So at least it says changed at the margin. We'll talk about that, but we don't get overly fixated on what the final endpoint piece of data is underpinning a lot of our views around what's happening from an overall change perspective. We also need to understand where we're at for Trump 2.0 relative to where we were within Trump 1.0. And so this chart at the top, are just very simple, just really looking at what's happening on a forward 12-month PE basis between the S&P 500 and overall emerging markets. And if we go back to January of 17 and look at it today, or certainly look at it at least at the end of December, but it's going to kind of rhyme, is the fact that our starting points are much higher, at least in terms of U.S. valuations, than they were during the first Trump administration. And then if you look at, say, emerging markets overall, they're, from a forward PE basis, kind of flattish or sort of in line to slightly down. But I think more importantly is, as you move from the left to right on this chart, right, that gap really starts to expand, because naturally emerging markets, certainly the index, is traded at a pretty decent discount to the S&P 500 overall. And part of it for good reason, because in aggregate, you've gotten better growth. You've gotten better earnings growth out of the US than you have emerging markets. But that relationship really started to sort of break away, right, over the last couple of years. And then at the same time, as we look at the chart on the bottom, whether we look at just the sort of standard US dollar index as represented by the DXY, which is mostly developed market currencies, so the yen, the euro, and the pound, or if we broaden it out to on a trade weighted basis, which layers in a lot of the more emerging market centric currencies, again, we see a similar picture where the dollar, certainly before the last, the last month or last month and a half, the starting point here was at a higher base than we were during Trump 1.0. And so I think at the same time, it's almost natural that when we were kind of talking about these things at the end of the year, talking about these things in January, where it just felt that so many folks were all on one side of the trade, and we're already at a much higher base than we were even during, the first time around, to the point where if we look at on this next slide, if we look at the headlines to the left, there was a Fortune Deloitte survey that was done back in mid-December, and basically of 140 CEOs of some of the largest companies in the world, 84% were very sanguine about 2025. And then not only that, half were very sanguine about the global economy overall. So they're very sanguine about their business. They're pretty sanguine about the globe. And then now more and more people were also seeing very large opportunities in AI. And this wasn't 5 years ago, right? This wasn't even 5 months ago, right? This was basically 4 months ago. And of course, we know that things have meaningfully flipped. And we've really flipped the script in a very short period of time. So again, we're just building and layering in this case that you're seeing a lot of things that are changing. There were a lot of folks that are all on one side of the overall, kind of U.S. exceptionalism, sort of thing right after the election. And now they're basically throwing a wrench, into the apple cart. And also to the point where just on this chart on the right, I just, it's kind of funny. It's just that when they were rolling out Doge, of course, the Department of Government Efficiency, you also saw another major leg up in Doge, the meme coin. So again, I think this is much more of around a sentiment indicator as we were coming into the last couple of months. And then that uncertainty around tariffs, naturally the background behind me discussing, highlighting the overall sort of view from the tariff situation is really just this big swing in sentiment in a very short period of time. And so as we think about a lot of these changes, as we think about a lot of the different things that have really been sort of underway, there's a lot of work that needs to be done. And of course, this is just a very simple chart highlighting U.S. federal debt to GDP. But as even we think about something like Doge and think about some of the cuts that, maybe that they have been making, but how much can they actually do given the overall, kind of fiscal situation, but also overall debt in the U.S.? But the problem is it's really tough, right? Because we've had an administration that's also said that we're not going to cut entitlements, right? So we're not cutting Medicare, we're not cutting Medicaid, we're not cutting Social Security. And then also, if rates aren't going down, of course, that continues to be a problem from the interest rate side of things, or debt service overall. And so this becomes a very big problem to try to deal with and also to try to cut your way out of, right? And you can see, of course, that the last time we were even close to these types of levels from a debt to GDP perspective, we have just come out of World War II. So there is a lot of work to be done, and there are a lot of things that sort of need to be tackled. Oh, and as we just discussed, the 2.0 situation is at a much higher base from valuations from the dollar, again, last couple of weeks notwithstanding. And so therefore some sort of, correction is natural. It makes a lot of sense to us. And then I think just lastly to this, overall point, I think this is really important to sort of underscore is the fact that this situation is very different today than it was in, the middle of the 2000s than it was during the GFC. And I think one of the major reasons for that is this chart here, is because if we take a look at U.S. net government interest expense versus U.S. non-financial corporates net interest expense, of course, as you can see, going back basically over 20 years, these lines more recently, as you move from left to right, have totally flipped. And there's a couple of good reasons for that, right? Number one, if you think about 2006, 2008, we think about the global financial crisis, that was much more a households and a corporates problem than it was an overall kind of government problem. And that's what the left side of this chart is showing you, where as we went into the recession in 2008, 2000, early 2009, the blue line went up. So net interest expense of corporates actually became more of a burden. Whereas even though the orange line went up a little bit, it didn't move nearly as much. But of course, as you roll to the right, you see that that dynamic has completely turned, where a lot of companies in 2021 and before, of course, rates were going up in 2022, you were able to issue a bunch of debt at very low rates. If you're Amazon, you could issue billions of dollars in debt in the twos. And then before rates came down a bit, right, you're earning 5.25 on T-bills. You totally flip the script, right? They actually get a positive spread between having such low rate debt and actually being able to earn a ton on cash, where the opposite has occurred, of course, at the government level, because we pile more and more and more debt. So again, we're layering all these different changes and really just parts of the overall investing landscape that we haven't seen, for quite some time. And then therefore too, and again, these are a couple months old now, but I think the point of, again, driving uncertainty and will things change and what is likely to continue to drive markets are things too around what type of resolution will we potentially see between Russia and Ukraine? Will the Fed actually, decide to cut rates, even if inflation remains, as it appears to be, relatively sticky, certainly above the kind of 2% target? So I think that's why we have this, this sort of title in terms of doves to fly or cry, which of course doves being a symbol of peace. So will we get a peace dividend? And maybe is that some sort of expectation around those peace dividends being worked out through kind of European markets? Because I do think that those would be the biggest beneficiaries if anything like that actually came to a proper resolution. And then at the same time, that sort of push and pull and this tension around what's really happening from an overall central bank perspective, specifically what's happening with the U.S. central bank. Because as we've already seen in 2025, we're seeing things like the ECB cut rates. You're seeing things like the kind of fiscal impulse and the fiscal response coming out of Germany as a response to a lot of the uncertainty and a lot of the different things, that we're seeing overall. So again, just all the different types of uncertainty. But at the same time, while I do think that this picture is probably maybe slightly more on the negative side, it need not be overall negative, because we do have a lot of push and pull and a lot of tension just occurring across all these different domains and all these different dynamics. But then therefore within that, it does create a lot of different opportunities. And maybe this last piece before we highlight a couple of those, I do think this is important too. And this was so prevalent last year, particularly as we were talking about politics and we were going into the election, and folks were, should we change the portfolio? What should we do? Based on the U.S. election. But the reality is, at least in the U.S., historically, going back, 50 plus years, in absence of an economic decline, in absence of a recession, not in nominal terms, U.S. equities have been just fine. And so, of course, as we can see here, and as we know, really the only times that the U.S. equity markets really didn't do much were within the 70s and 80s, because there were multiple recessions. And then from the peak of 99 up into, kind of 2012-ish, again, kind of peak to peak basis, because we had multiple economic declines. And so a lot of talk about will we or won't we have a U.S. recession? Of course, we're not in the game of making, big forecasts. Our view is we're much more about preparation than prognostication. But I think that with some of the data that's coming out, it is interesting if you do get a recession in the U.S., and I didn't check the numbers, within the last couple of days, but Atlanta Fed's GDP nowcast for Q1 has been pretty negative. But it's been a lot of interesting adjustments and dynamics, particularly folks trying to front run via imports a lot of the tariff burden that may come through. So we'll have to continue to, of course, watch the data and see what happens. But this will be a very, if we do end up a U.S. recession, it'll be a very strange one based on the dynamics, based on things like imports, et cetera, et cetera. So a lot of things there to continue to watch. I want to skip that last slide and just come in on a couple of more. As we think through some opportunities, of course, we discussed a lot of the data in China. I think from our perspective, what is interesting and our bias has very much been over the last couple of years, overweight in an area like India, underweight in an area like China. And even if we go back, 3 decades, broadly speaking, that's kind of been the thing to do. Is that if we compare since early 1993 until basically the end of February of 2025, of course, you can see the delta across these lines, with the green line being MSCI India, the black line being the broad MSCI EM index, and then the grayish line there at the bottom being MSCI China. And that's why for us too, as we think about something like macro, which is unbelievably important, which has almost been required to at least have some sort of view on the macro in 2025. But it's why for us, it's much more of a risk management tool than it is an alpha driver. So we're never looking to add alpha by looking at macro, but we do look at it as risk management of not telling us what to buy, but being a very good tool potentially in terms of telling you what to avoid. And I think this chart is a good illustration of that. Because if you think about China on the bottom, you had a huge macro tailwind for many, many, many years, right? It's the second largest economy that came into the WTO, massive growth in consumption, massive growth in terms of the middle class, very high GDP growth. But from an equity investor, from a minority ownership perspective, it didn't work. And a big part of that is not only earnings growth, but also a part of there was a lot of value destruction along the way, certainly in terms of that index overall. So with all these things, we continue to view a lot of opportunities in India relative to China. But here is the big reason why. And as we always like to say, earnings are like gravity, in our opinion. You've gotten much better earnings growth out of India relative to China. And this goes back to 2009. But of course, as you folks can see, with the India being kind of the grayish blue line, China being the orangish line, you've pretty much, with rare exception, over that time period, just gotten much better earnings growth out of India than you have out of China. And then, of course, as you can see, it's accelerated a lot more recently. And so our view is that that's very much unlikely to change. And so, again, just continues to color our view that we're finding a lot more opportunities in India. And we're also finding a lot of them within the more kind of infrastructure and energy space. Now, number one, part of it is because what we're highlighting here is the fact that after a lot of years of talking about it, really since 2018, 2019, the government has been investing heavily across this space. And that's what you can see on the left, where we basically had 3x the growth over the last 5 years through the end of 2024. And now with that chart on the bottom, you can see what that looks like on a GDP perspective. And so these numbers are real, and these numbers are massive overall. And then I think the secondary piece to that is actually what's kind of nice, again, in the 2025 regime, is the fact that because these businesses are so domestic oriented, because it's focused on things like infrastructure, power demand, building airports, all these types of things, those really are not impacted by the tariffs, right? So whatever's happening from a tariff perspective, these aren't exporters, these are domestic demand focused, and these are big structural drivers that, in our opinion, don't really have a lot of issues, kind of on the tariff side of things, and so are nicely insulated from a lot of these different headlines, and have a nice long liveness to them, both from the assets perspective, because of course they take a long time to actually put up, but also because they last such a long time. And this ability to connect the country, build airports, increase energy demand as they grow overall, in our opinion, this still has a lot of legs. It doesn't work every day. It doesn't work every quarter. But again, in terms of looking for kind of structural opportunities amongst all the uncertainty and the volatility, our view is that India remains, one of those pretty interesting and kind of key bright spots there. So I know I just rattled off a bunch of stuff very quickly. Hopefully that all made sense, but I do want to be conscious of time. We crossed a little bit over 20 minutes, so let me pause there and certainly see if Aaron, if there any questions that popped up, or if you want me to elaborate on anything else.
Thank you, Josh. So we're going to open up the Q&A function on Zoom. If you have any specific questions that you guys would like us to fire away over at Josh, feel free to type those into the Q&A section, and we'll do our best to cover those. Before we kick off with some of the questions, as they continue to try to type those in for you, what do you see as the biggest opportunity out there with any traction, things getting settled, tariff stuff, noise behind us? How quickly does the market rebound and react to some positive news on the tariff side?
Yeah, no, Aaron, I mean, I think it's a great question. Well, I think, if we've seen the fits and starts of this, right, over the last couple of weeks, that really any sort of positive headline or interpretation that either things won't last as long as maybe some folks think, or of course the barriers or the actual dollar amounts or percentages, whatever, won't be as high, are met with a pretty strong, positive impulse. So I think it just really depends. I think it depends on how concrete a lot of these things actually are. And then I think it still depends in terms of the overall kind of sector, right, that we're thinking about. And so to us, just in terms of the way we're thinking about things today, we continue to be pretty defensive, meaning we're overweight areas like utilities, like staples, because we do think that whatever resolution that we come to, it won't be, it will still be somewhat problematic for earnings of a variety of companies, particularly in tech, where we think growth is coming down and valuations remain too high. But again, I think that if you can get a little more certainty around what that go forward picture is going to look like, I do think you'll get a positive response. But in our opinion, it won't just be totally uniform. And even within this backdrop, you want to be very cognizant of the prices you're paying, for these types of things, particularly those that had a lot of growth over the last couple of years.
Being that you guys are so nimble and a really active manager, moving in and out of positions as timing seems appropriate on your end, how much do some of those headline numbers, headline reactions, headline comments, how much do those drive the day-to-day decisions within the portfolio? Or are you guys still stepping back and looking at the underlying fundamentals, even though you might take a relatively short-term stance on a specific company?
Yeah, sure. So I mean, depending on what headlines we're talking about. I mean, certainly, we're not moving the portfolio around and trying to have a knee-jerk reaction to any next incremental headline, which generally is around similar topics or some variant of the same topic. So of course we have to watch these things and we pay attention to them, but we're not necessarily reacting to all of them. However, because we always have this process of following the data, you can't ignore them, and so you're continuing to gather what's coming out, what's likely to stick, what's not likely to stick, in order to have an informed view of, are there now things that are becoming more or less attractive based on what is, again, likely to stick on a prospective basis. So we don't want to get overly engineered to headlines, but still, you have to follow the data. We have to pay attention to them. But sometimes, if you get these really outsized moves, again, they can create a lot of opportunity if we think that the fundamentals of something remain intact and combined with, a valuation that is attractive overall. But I think, again, from our perspective, what is tough is the fact that, if you think about the administration, if you think about, Trump, he's been talking about tariffs and things for 40 plus years, right? So it's not really new. And they've been not in everything they've done, certainly, but they have put out a lot of different papers. They've targeted a lot of different things of kind of telling you how they're thinking about it, not moment to moment, but kind of structurally. And so for us, that does continue to put a lot of question marks in terms of, again, where growth is meaningfully going to accelerate, how well China is ultimately going to do. So again, it really just depends. But you can't put your head in the sand, and we're just always looking for, even within, even as things roll over, there's always a bull market somewhere, and that's our job to try and continue to find those things.
Well, again, we want to be really respectful of everybody's time, so why don't we toss one last kind of open question to you? Any parting thoughts for us today, and things to be thinking about as we continue forward in our investing journey?
Yeah, for sure. No, I mean, so certainly thanks for the opportunity today. Thanks for the time to talk to everybody. And I guess the biggest understatement is it's very interesting, sort of times indeed. But again, I'm just going to kind of repeat myself, at least from the perspective of even when the headlines are negative, even when things are negative, there are always opportunities, somewhere. And so, like again, for us, I think that our view is that really EMX China is a very interesting opportunity. Certainly, kind of steady eddies within the U.S. remain very interesting opportunities. And I think it's really those sort of laggards, for lack of a better word, over the last couple of years that as we're seeing opportunities now, and this is all subject to change because, of course, as we know, things change. There remains very interesting things, to buy, not just to be super negative on everything just because, maybe on a moment to moment basis, things don't feel super sanguine.
Thank you so much for your time, Josh. Thanks everybody for your participation on the call today. And certainly reach out with any questions if you have anything specific to your situation. Appreciate it. Thanks again. Have a great night.
Thank you, folks. Have a great night.